Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar titles tonight is Investing Through a Recession. So welcome, everybody. My name is Shen Chu. I'm the moderator for this session. Now, recession is one fearful word that everybody gets very nervous. But recession is also part of an economic cycle. Okay, it is bound to happen. Okay, this is a matter of when will it happen. Okay, and oftentimes during the recession period, there are informed investors who can make great fortune during this fearful period. And in this webinar, we're going to explore strategies or the state of mind that we required to succeed, and what are the investing strategies that we can use to survive and also thrive in this recessionary period. So before we begin, as usual, disclaimer, whatever we're going to share in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now, allow me to introduce our speaker briefly today, and he's none other than Mr. David Poh. Now, David is the co-founder and managing director of Spiral Thinker Groups in Berhad. He is a thinker, wealth creator, and value seeker. He's an engineer by training, and now he's a full-time private investor. He also serves as a portfolio consultant, and he advocates intelligent value investing. And personally, he believes in long-term wealth creation with equities. And today, we are very honored to have you here with us today, David.
Hi, good evening, Shane. Thanks for having me back again. Can you hear me loud and clear?
Yes, can hear you loud and clear.
Great.
Can't wait to learn from you how to invest through a recession.
Yeah.
So over to you.
Can I take over the screen, please? Yeah.
Please.
Thanks a lot. So again, good evening, everyone. Thanks again for inviting me back here to speak to you all. Tonight is pretty interesting. First of all, again, thanks to Shane and Chunxie and LifeChamp, as well as Bursa Malaysia for the invitation. Now, this is a pretty scary title to a lot of you who are listening in tonight, but I personally feel pretty excited about it. Right, like what Shane Chunxie mentioned just now, recession is just part of the economic cycle. It is unavoidable. But what we can do from our end as an investor for the long term is to prepare for it. So my objective tonight is very simple. My objective tonight by presenting this webinar is hopefully to dispel the fear of recession among all of you by the end of this webinar, right? This is going to be a pretty relaxing topic. Pretty relaxing evening. There's not much technical terms or technical aspects that I'll be covering, but mostly more on the psychology aspect as well as a strategy from our point of view, as we have been investing in the market for quite a number of years. And as usual, I usually split my session to 3 or 4 main parts. So first of all, I'm going to talk about what is recession and why it is inevitable that we are facing a recession soon, right? Then, of course, after knowing what a recession is, how do we actually prepare for it? How do we prime? How do we prepare our mental state as well as plan our strategy to face a potential oncoming recession, right? I'll talk a little bit more about optimizing cash balance and equities exposure. This is not new if you've been following my webinars with LifeChamp for the past many years. I always advocate that one of the ways for us as small retail investors, one of the ways that we can protect our portfolios, our investment portfolios, is really by making sure that we optimize our cash and equities ratio. And last but not least, I'm going to do a very quick case study on some allocation by sectors. Unfortunately, I mentioned to Shane just now before we started, there will be no stock picks tonight, but I give you an even better one. I'm going to share with you what are the potential sectors that we are looking at even through this recession. All right. So hope you stay with me until the end. Yeah. How come Okay, great. Just a quick recap. We have been delivering quality educational webinars with LiveChamp platform since 2018. I think altogether we have about close to 20 titles, right? As you can see in front of you here. Now, when I collate all these titles, right, I try to categorize them. I found out that actually a lot of these titles are related to the sector case studies. And if you have followed me since the beginning, you know that we focus a lot on semiconductor as well as technology. Now, the second biggest topic that I usually cover is portfolio management. Interestingly, I think there are more and more webinars and seminars out there. They are touching more on portfolio management styles, techniques, strategies, and so on and so forth. So I think it is a good trend. But for us here at Spiral Thinker, we will be moving away from this topic and to focus more on what we think is lacking in the market. So as you can see from our sample size here, we notice that actually strategy and psychology is something which could be interesting and something that we think that the public would like to know more about, to learn more about. Okay, it is evident from for our topics since 2018 that there are only two topics on psychology and two topics on strategy. So moving forward, we would like to focus more on these two, starting with tonight. So tonight, what we're going to share is not something that you can get out from textbooks or theory. This is really a combination of what we have went through, what we've experienced being a long-term investor in the market for almost more than a decade now. Is usually mainly a lot from our mistakes, because from mistakes that we learn. Fortunately or unfortunately, I personally have been through, I guess, 2 or 3 huge market setbacks. One necessarily quite a recession. Perhaps 2008 was the biggest recession experience for me. But I think you get my point, right? I think I would like to focus more on the psychology as well as strategy aspect. How do we invest through a recession? Okay, now to kick things off, I'm going to talk about why recession is inevitable, right? Now, I'm not going to go through the technical details or what is the definition of recession. I think you can get it. You can Google on it. There are many. There are technical definitions. There are other definitions of what creates a recession. But as you can see here from the latest, this is a pretty new WEF World Economic Forum report just released back in January 2023. It says they collate what do globally, what do chief economists expect on the risk of stagflation. Now, although this title is not recession, but stagflation is as bad, or in my opinion, sometimes can be even worse than recession. As you can see here, especially the statistics on the developed markets, right? Countries like United States expects 91% that they expect to have a weaker economic growth in 2023. In Europe, it is worse. Almost everyone that was polled agreed unanimously that they are definitely going to head into a weaker economic growth time, right? Then we have countries in Central Asia, Sub-Saharan Africa that expects the same thing as well. Interestingly, areas like East Asia, where we are at, Southeast Asia, the statistics wasn't as bad. Now, you may be wondering why. China as well, right? Now, probably because of our economic ties with China, and you will learn that actually China is one of the countries that is still growing modestly compared to, they expect to grow modestly in 2023. Their credit cycle is still comparatively healthy compared to the other developed markets. So probably that is the reason why over this part of the world, the fear of a weaker economic growth is not as pronounced as the other developed markets. But I think all in all, everyone expects that the high inflation to persist, except for maybe China, right? And this is very important because later on during my presentation later on, I will be introducing a concept called the Davis double attack or Davis double play, which has a linkage to this expectation of economic recession or stagflation. Okay. Now, so in the report, in fact, 100% of the poll economists, they agree that geopolitical tension will play an important role, all right, to navigate the investment landscape in 2023. And a lot of them actually, a lot of the companies and participants that was polled, they expect, companies to cut operational expenses, they will lay off even more workers, right? But good thing is they realize the importance to optimize the supply chains, right? So I think there is a silver lining here. But as you can see here, I think it is happening, and we can see already that companies are laying off workers, or they actually freeze hiring because they expect that the economic growth is going to be weakened in the foreseeable future, right? And so much so that in US alone, this is a statistics compiled by the Conference Board of the United States. They are the, I think, responsible agency to announce to the world whether US is going through a recession or otherwise. So according to their statistics here, it seems that the recession, the probability for US entering into recession is actually close, is actually 1. It's a given, right? Now, I think the latest, for the historical reference, you can see here back in 2008, the same thing happened. In 2020, we actually had the similar situation, but perhaps in 2020, because of the global pandemic, governments around the world as well as central banks around the world kick in. They were very cooperative, right, to try to avoid a full-blown, full-scale kind of global recession happening. And that's why you can see that the probability chart actually was only a spike for a very short time, then it came down, but now it's coming back up, right? What we had delayed is inevitably coming back to bite us even deeper, in my opinion. So I talked about this, I think a couple of years ago in one of the seminars called Sustainable Long-Term Investing with Fundamental Analysis. What causes a recession? This is called a vicious cycle. All right, that what can happen to lead to economic recession, falling consumption, falling productivity, which I think these two has happened. As I think post-pandemic, right, because of the rising inflation, because of the rising cost of living, whether it is housing or the staple food, the necessities, right, they are all rising in terms of cost. So that will drive down consumption because a lot of households, they will have less disposable income. And that will lead to lower productivity. Why? Because companies need to protect their bottom line. So they will rather produce less than more. And I think since last year, I think what I'm sure that you have heard of this term called inventory adjustment, especially on the semicon as well as technology sectors. A lot of these companies are actually still digesting or still adjusting the inventory to try to sell off all their existing inventories before they can produce new stuff. And eventually that will lead to, a declining employment. At the moment, I think it's still not too bad. Whether it will fall until such a level where it will jolt the central banks to kick back or pivot some of their policies is another, I think it's yet to have been seen. That's why I put a gray color here. And if that were to happen, I think, with a higher unemployment rate, if unemployment rate is climbing, definitely it will lead to even more reduction in income in a blanket basis, right? And if that happens, right, I think it will the cycle will continue to compound itself. And all of this is being exacerbated by rising interest rates. And if you ask me whether interest rate will continue to rise I think right now the consensus is not so, but my opinion is the interest rate is likely going to continue to remain elevated. Like even today, right, Bank Negara just announced a 25 basis point hike, which was kind of expected or not. But the truth is, I think our central bank cannot avoid this anymore, because if they do that, then they may run the risk of widening the gap with developed market central banks like US, the interest rates. Okay, I've shared this as well. The economic cycle, usually how I simplify this, right? So right now, I think likely what we are going through is a slowdown of the economic growth, while still inflation is still pretty much elevated. Although the data print, the inflation data print from developed markets like US and even Europe or UK, right, they are plateauing, but they are still pretty much on the high side. And if you ask me, if you were to ask me, do I expect the inflation, the print to come down in a big way? I doubt so. I think it will remain elevated for at least quite some time. So that is why, the definition of stagflation is, slowdown of economic growth, rising unemployment, while inflation remains high, which is actually a bit different from recession, where recession we don't have a high inflation. In fact, during a lot of the recessions, past recessions, we were actually going through a disinflation, and this is something not good for everyone, right? So I think we are going through this slide here, economic slowing down. Now, whether the inflation is going to plateau and turn down, and for us to come to this area or this part of the economic cycle where economy will contract in such a scale that will lead the central banks to U-turn or pivot on their policies, I think it's a question that begs to be answered. And this is a question that is on everyone's mind, but I do not think it will happen anytime this year. Probably, at best, depending on how the inflation print, the future inflation print is going to be, likely it's going to be either the middle of next year or second half of next year. Okay, and that is not necessarily a good thing. In fact, personally, I was hoping for this to happen much earlier, so that the market can digest all these, headlines, headwinds, and then you can move on from there, right? So what can lead to further economic slowdown or contraction? One of the things that we are focusing or monitoring very closely is this phenomenon called capacity destruction. Now, I think a lot of you have seen headlines that a lot of companies are laying off. That is what we call employment destruction, right? So because consumption falls, is declining, then that which leads to companies not needing to produce so much. So definitely they will cut their workforce, their capacity, right? So this is something that this definitely is happening, right? You can see that a lot of these consumer devices are cutting their production, even Apple, so on and so forth, right? So but there is a silver lining here. So I'm not sure if you heard of this term called creative destruction. It is something that was coined. It is a term coined by, I think, a famous Austrian economist called Joseph Schumpeter. I don't know how to pronounce his name, but basically, in layman's terms, what it means is sometimes, the economic structure has to be decoupled, and some parts of it needs to be destroyed in order for new things, new activities, new productivity to come online and create new jobs, right? I'll give you a very simple example. When petroleum was discovered, oil, right? it actually put a lot of these mining workers, those steam engine workers out of job. All right, but it did create a new work. I mean, a new group of employment opportunities for those who know how. I mean, for a new technology, which is electricity. Now, the same thing is happening today. We all know that oil and gas is going through a sunset. Oil and gas is sunset, right? I think it's going to be good for at least a few more years because I'll explain later on about this investment thesis. But because of the need for a cleaner environment, cleaner energy source, it creates a lot of new opportunities in the renewable space. And in order to make it happen, we need a lot of new jobs, new skill sets, new experts in that particular area. And that is where this is an example of creative destruction. And hopefully, with this economic cycle, it presents good opportunities for those really old tech or old businesses to just phase out, to make way for the new types of the new economic structure, right? So this is something that I look forward to personally. And coming back to just to wrap things up on why I think and why we Aspire Thinker think that recession is inevitable. I would like to bring back this gentleman. I think his name is Shelby Davis. All right, he's coined this term called Davis double play or Davis double attack, which is a double whammy market impact. Let me explain further. Now, so we all know that price or the market price of a security is equal to the earnings per share of the underlying company, of the underlying business, multiply by their PE ratio, right? The price earnings ratio, or I generalize as earnings multiple. Now, as you can see, when market overheats, when the economy overheats, as what we have seen post-pandemic, right? When everyone was rushing to create more things to cover the backlog orders. And then there is also other issues or other things that happen, that the disruption of the supply chain, geopolitical tensions like the war between Russia and Ukraine really totally disrupted the economic balance, and it led to even further inflationary impact. So that leads to high interest, and when we have high interest, generally the investment climate will be more risk off than risk on, and that will eventually lead to multiples contraction. At the same time, with high inflation, when the cost of capital or the financing is getting higher and higher, it really hits on the consumer confidence as well. Then which will lead to lower demand, lower consumption, and which in turn will also lead to multiples contraction or lower earnings for the enterprise or the businesses that are affected. So I think with the high interest rate, we can see that actually there is already an earnings multiple derating of the earnings multiple. Give you a very simple example. Back in 2020, right? When I'm sure you all I'm sure you all still remember the glove mania. Remember that there was a point in time where glove stocks were priced at earnings multiple or more than 100 times their PE, right? Remember those days? So today, what happened to those? Today, even a PE of 30 times or 25 times is considered very expensive. Why? It is due to the multiples contraction, right? And you looking at this very simple formula, right? Assuming earnings per share stays the same, they are flat. And when earnings multiple comes down, because market is less willing to pay a premium for premium price to acquire a business, naturally the demand for the business will come down. So naturally, the price of the security will come down, all right, assuming this is flat. But as we know, with lower consumption, that leads to lower productivity. This would eventually likely hit the earnings or the profitability of the affected business. So assuming a full-blown economic contraction, right, the earnings per share of the S&P 500 or whichever indices that you follow is going to come down. Now, and you can see here, if earnings, the multiples are contracting, earnings per share is getting lower, definitely there will even cause a further contraction of the price. And this is why I think that this is a double whammy for the stock market. And I don't know. I mean, the US is still going through its first quarter earnings season. At the moment, except maybe for the regional banks, some of the financial sector, or some semiconductor companies, right? Things are not looking as bad as feared. In fact, some companies are still getting pretty good guidance. So probably the the downgrade of the future earnings per share may not happen this earnings season. But I think as long as high inflation continues to persist, consumption continues to remain low, this will definitely happen either 1 quarter or 2 quarters down the road. The problem is, the longer we prolong this, it may cause the inevitable the inevitable contraction to be even more painful than it already is. Okay, so I'll talk about why we think that economic recession is inevitable, and how it will impact the stock market through this very simple analogy. Next, I'm going to move on to, after knowing that, of course, you've got to prepare yourself, right? So I'm going to focus more on the mindset as well as the strategy planning. All right. So we have, we have already talked about, business cycles going up and down. After every peak, they will always slide to a trough. Right now, if you ask me, we are still sliding down, and the slope is getting steeper and steeper. We are not at the economic depression yet, but I think we are on the way there. But okay, here's the good news, right? The good news is that it's a cycle. It doesn't mean that when we slide into the path of recession, right, we are going to stay in depression forever, unless we may see a 1930s kind of history to repeat itself. But barring all circumstances, right, I think that even if a recession is inevitable, recovery is also inevitable. And humans, we are a species that we are a survival species, and we are a species that also thrive. So even though, we may be sliding into the inevitable path of recession, all right, or even, the possibility of economic depression, I believe that there will come a point in time where things are become so cheap, and then the economic structure will mutate and reinvent itself to make way for new businesses, new economies to come, right? So I'm pretty much looking forward to this recovery period. The only problem is time. Now, I do not know, and in fact, you ask any economist, right, they won't be able to tell you that when it will happen, number one. They also won't be able to tell you how long it may last. God forbid, we definitely don't want to see a repetition of 1930s economic depression. It does not benefit anyone, but just barring all unforeseen circumstances, I don't think that will happen. And probably even if we kick into a recession, right, with all the financial tools, with all the central banks getting ready to act on it, right, perhaps this recession may not be as long-lived or may not be as severe as everyone fears. All right, but definitely, from my point of view, I'll be looking towards this recovery period. Okay, and so with that in mind, right, actually the secret is very simple. Always, the simple way to tackle this is always remember we are investing for the long term. We're always investing for the long term potential of economic growth, but we got to be mindful of what are the challenges ahead. All right, now Susie Orman is a very famous financial planner in the United States. So I think she made this very famous quote that the key to making money is to stay invested. All right, so this is particularly true when it comes to equities or stock investment. I do not believe in the notion of getting out of the market and then come back after a few years when things get back to being rosy. I always believe that no matter what we do, no matter which cycle we are in, right, whether we are sliding down or at the peak or at the trough, right, we have to always remain invested, meaning we have to put our money at work, put our money in businesses, that, I mean, regardless of how the economy is doing, there will be, because as humans, as societies, they have needs. We need food, we need lodging, we need transportation, regardless of rain or shine, right? So there are bound to be businesses that are still cater or that still have businesses, right? I mean, still can still should be doing pretty well. The problem is whether the market is willing to give them that kind of valuation. That is another matter, right? But the key here is to remain invested all the time. But our strategies cannot be fixed. Our strategies, our investment strategies should always reflect the market reality. What do I mean by this? I think if you talk about back 2 years ago, 2 or 3 years ago, when cheap money or there's so much ample liquidity in the market, when financing is so cheap, right? And this will lead to the opposite of multiples contraction. I don't know what's the word, but what I'm trying to say is market is willing to pay an even higher premium for companies that it has a good growth prospect, right? I think back in the day in 2021, I think if you have invested any good semicon or technology stock, you would have made a pretty decent return for that year. In fact, 2021 was one of the best years in our journey of investing, all right? Because as value investors, we are generally looking at maybe between 15 to 20% compounded return per annum, which translate to doubling of every 4 to 5 years, 4 to 5 years. But that year in 2021, because of our exposure to technology stocks, we made almost close to more than 40% return in that year. Well, pretty good year for us. So, but now, if you say that if we were to stick to that same strategy today, right, we would have been punished by the market because of what I shared just now, right? Because of the rising interest rate, that leads to earnings multiple contraction, and this will hit particularly on the high growth sectors like semicon and technology stocks, right? So, like it or not, being in the market for more than a decade now, I realized that actually we have to really react to what the market tells us. So we cannot be stubborn about it, all right? Unless, of course, you are a super huge investor like Warren Buffett, where you can't move because your funds are so big that if you sell, right, you will cause the market to fall, to crash. You will be the self-fulfilling prophecy, right? Okay. And that is what we should do as an intelligent investor. We should always reflect. I mean, our strategy should always reflect what the market tells us. And more importantly, what we should not do is to follow the herd mentality. Okay. For example, back towards the end of 2020, when we saw that actually the Gulf valuation on the Gulf stocks were crazily high, didn't make sense, and we noticed that this China capacity is coming online in a very huge and fast manner. So we thought that probably it's time to get out of the Gulf. To reduce our exposure in the Gulf, and we were right. But that time, I remember that because of everyone was rushing to buy Gulf stocks, right? We were criticized. But of course, on hindsight, we are not happy that we were right, because a lot of people lost money. But most important is you have to do your homework and don't follow the herd just because everybody is thinking the same thing or buying the same stuff, right? Doesn't mean that we have to follow. So okay, so this is the key. Invest for the long term. Don't lose sight of the long-term prospect, but be mindful of the near-term challenges. Right. So how did we do that? Practically, right? So this is a case study for 2022, a more recent case study. Basically, what we did was for that year, all right. We basically divided the whole year to 4 quadrants, to 4 periods, which is Q1 to Q4. And our initial outlook, or how we strategize was, okay, in 2022, we know, the first half of the year, I think everyone was saying, all the economic reports were saying that, oh yeah, things are not going to be too well. So of course we had to reflect, what we plan to do along those lines. So we were pretty defensive. We were busily managing the downside risk of our portfolios. That's what we were doing. And then we thought, okay, in quarter, so we did this in quarter one. So we thought that, okay, in quarter two, things should improve, should not be as bad as quarter one. So there will be the time where we need to look back at our strategy for that year to realign what we see to what is happening to the market, and perhaps we need to update our allocation plan. Then, of course, in the second half of the year, our focus would be to really enhance the return of portfolio, and to really focus on our allocation on the sectors or the stocks that we believe would have a better upside or risk reward ratio for us for the year. So this is the plan. Of course, we know that, I think if you are in the market as long as we are, you notice that whatever we plan, usually that it won't happen, right? So in reality, what happened to our portfolio, most of our portfolios is like this. So this is taken from a real portfolio return for 2022. As you can see here, for the first couple of weeks, we were doing very well. The portfolio was rising about 5 to 6%. Then after that, it went all the way down. Now, I'll explain later on in the later slides what caused this to happen, what led to this. But because we had a plan and we knew that somehow in quarter two, in the second half of the year, there should be ample opportunities. So this is what we did. Now we pulled the plug here towards somewhere in the middle of the year, where we reduced our exposure on semicon stocks, perhaps a bit too late, because I think back in the end of quarter two last year, we were still about, I guess, 50-60% exposed to tech stocks. So we didn't act fast enough. So we were also learning along the way. But good thing is we did, because the Bursa Tech Index actually slide about 34% year on year, all right, for 2022. Then, of course, we had some good trading opportunities towards the fourth quarter of the year. That's why we were able to close the year with a decent performance. Not great, but it's not too bad. All right, and that was when we look back at some of technology stocks as well as IPO stocks that is related in the rearm of the technology space. Okay, so that was what happened in 2022. Now, the key message here is, we should, by being mindful of what are the short-term expectation or what the economy or the market is going to be, we need to relook at our strategy and see how we can enhance or how we can update, what we plan to do. Or perhaps you think that, you're very confident from your studies that, everything is going to go down the drain. So you may want to keep a higher cash balance, which is fine, but always remain invested. I do not personally believe in keeping 100% cash. That's not my philosophy. Always at least be, I guess, the minimum exposure will be 20% stocks and 80% cash. But that rarely happens. Only when when we have a deep crash, like back in 2020 around March and April, where my cash position was about 75% that time. Okay, so this is what we did, what we planned in 2022 versus the reality of what actually happened to our investments. So with that, most important thing is we've got to be prepared mentally, and and this is one of the ways that we mentally prepare ourselves of the headwinds or the opportunities for that year. And then we have to update our strategy based on what we expect. Now, what we expect or what we project may be wrong, but at least always we got to be agile. So I talk about the benefits or the virtues of being agile or nimble, because we are small in the stock market, which is actually an advantage to us. I think that was in one of the webinars on portfolio strategy last year. Okay, so it is good to be small, and at least we can move about, right? Imagine those big funds. If you have a portfolio of more than a couple of tens of millions of ringgit, right? It may not be so easy for you to move around or to take profit or cut loss in the market climate like now. Okay, moving on. So usually how do we balance, or how do we strategize? It's really by tweaking the ratio between how much cash we hold versus how much of our capital or our portfolio is exposed to equities, right? And in this particular regard, it's always, you know, a battle of, are we underinvested or are we overinvested? And this is something that I don't think there is a good answer, or there is any metric that can show you, oh yeah, you know, you should invest so much so in this particular time, right? So it is usually a balancing act, and this is usually empirical, something that you have to learn through experience, as well as, you know, how much you know about the sector or the companies that you invest in. I'll give you an example. Back in 2020, you know, sorry, let me zoom in a little bit for you. My eyes are not very good these days. So this is the allocation visualization of one of our portfolios back then in first half of 2020. As you know, our portfolio went down from 5% beginning of the year to negative 14%, the lowest point, which is around the month of March or April. All right. So as you can see here, that time we were still pretty much exposed. Or our cash balance was about, say, I think our cash balance was about 30%, right? So we are still pretty much invested invested. Then we said, oh, we pulled the plug again a little bit too late. On hindsight, we should have, you know, raised more cash around this time, but we didn't. So we only managed to raise the cash near the bottom of the stock market on the throw, right? But good thing is, you can see here, we increased the exposure of our gloves along the way. Of course, you may be asking, hey, David, how come you didn't increase it here? If you increase your exposure on glove here, you know, you should have done much better. Yes, on hindsight, you are right. But at that time, because we didn't have much insight into what, you know, the gloves produce are actually faring, you know, the only time where we really, you know, decided to go all in a way, so to speak, was when I think I can't remember whether it was Top Glove or Supermax or Hartalega that announced, you know, they have a backlog of more than 2 years in the orders. So we thought, oh, this is a sure sign already. This is one of the key indicators that we are following. And that was when we decided to go max out, to push our allocation all on glove stocks all the way to 60%. 60% of our capital at that time was invested in glove stocks. Top Glove, Harta, Supermax, Kosan. All right. And there are some others still remain invested. And then we have about 25% cash right here. Okay. Now, so because of this, conscious, strategy or conscious decision, to do this based on, data or the information that we have, right? We managed to pull out our performance from a low point of negative 14 to a positive 24% for that, until the week 30th. I can't remember what happened towards the end of the year, but we did pretty well in 2020. Now, then in 2021, when everyone was locked down at home, and then when we saw that actually the demand for consumer devices shot to the roof, we decided to, when we were selling down our glove stock, we decided to rebalance our capital more to technology stock, especially on the consumer devices, companies like Inari, Unisem, MPI, so on and so forth, right? So we did pretty well at first in 2021. So like I mentioned just now, 2021 was a pretty good year for us. But in 2022, by the way, this is a portfolio allocation chart for the whole year of 2022 from week 2 to week 53. As you can see here, we were, in fact, for the first 1.5 months, for the first 1.5 months of 2022, we were close to 50% for this particular portfolio. We were close to 50% exposed to tech stocks. All right. And as you know that actually Bursa Tech Index were down 41%, for the first 3 months of the year. So rightfully, our portfolio was hit very badly that year. So I think towards the middle of 2022, our portfolios were mostly down about between 15 to 20%. So it was quite bad that time because of our exposure to tech stocks. Even at the bottom right, you see we were still about 15 to 20% exposed to tech stocks as well. So this is part and parcel of our type of strategy where we were very focused on a particular sector. And in our case, at Spiral Thinker, our investment thesis has always been around tech and tech technology, right? So in 2022, as you can see here, as I mentioned, we were still very much in tech, but of course, thankfully, we did some trading towards the end of the year, which managed to pull up our performance, which I was shown earlier on. Okay. So in 2022, if you ask me, we are still pretty focused on tech, but our allocation on tech stocks is very much lower now. We are shifting our focus more on value growth, all right, and some other sectors that I will share on a bit later. But in terms of the cash to equities ratio optimization or balancing, right? In those good times, when ample liquidity was available, companies or enterprises around the world were able to get cheap financing, all right, and it is relatively easier on hindsight to invest, and just wait for invest in a good company, wait for the market to discover its valuation, its value, right? So those are the times where we can just buy into a stock, a group of stock, and hold it on the long term, and it's pretty stable. Right? If you can just draw a straight line here, right, it's pretty stable. And in fact, you can see that we won't keep a high cash balance in normal times. This is a top-down strategy for how we balance cash and equities exposure. But in volatile times like 2022 and 2023 or even 2024, where there are so much uncertainties looming, on above our heads, right? And even the economies who worth their salt were not able to tell us what we can expect. So probably this is the kind of strategy that we'll be deploying, right? It's very different from the top one during normal times. Now the difference here is our cash to equities ratio is going to zigzag like this, meaning we will engage more on the bottom up stock picking strategy or angle, all right, where it's more for trading, short-term trading. We will not follow our old strategy of buying and holding for a longer period. In fact, we will shorten our period. Maybe we wouldn't use holding period as our as our deciding factor, but in fact, we will be looking at perhaps more to the upside. For example, if this company, this stock price came down, retraced more than 10% already, and we feel that it is a bit oversold, then we may put a little bit more allocation for this particular stock, and it goes up, say 8, 10, 12, 15%, right? We will be selling that trading portion of the stock. And as you can see here, if things get pretty bad, or when things are clearer that the economy is really not doing well, then we don't mind to keep a higher cash balance like this. So I think myself and my team, we are prepared to hold, maybe in the worst case scenario, maybe 70 to 80% cash, so that we can ride through. But we will still remain invested. There are still some companies that we feel is good, especially those companies that still pay good dividends. And you'll be surprised that actually there are a lot of companies today that in KLSE that pays a dividend more than 4 or 5%. And I think those are the companies that is worth the track, right? So those is how that is just a very simplistic way of how we manage, how we intend to ride through the impending recession. So right now, if you ask me, we are not here yet. Probably we are still, right now our portfolios is still about 50% cash, 50% equities, but we are very selective in what we invest in, which I'll share in the next topic, right? Which is case study on allocation by sectors. Now, before that, let's look at, I think I don't need to really talk too much about what are the headwinds in 2023. I think, as I mentioned earlier on, economic recession is inevitable. I think one of the things that perhaps not a lot of people are following is actually the housing sector in US. There are more and more noises, or more and more journals or media reports that suggest that actually US real estate is really not doing well. And the worst, and why that is important, yes, the the SVB and the First Republic banks, I mean their collapse actually walked the market out, but the central banks again were very quick and swift to step in to help dissolve the situation. But in our opinion, right, actually the real estate, especially the commercial real estate, right, could be an even bigger problem in US, and a lot of the big banks, right, the banks which capitalize more than $250 billion US, those banks are really exposed to the commercial real estates, and this is something that we have to be mindful about, right? So I think other than this, the usual suspects, high climbing unemployment rate, earnings contraction in growth sectors, tight fiscal and monetary policies, tightening contracting credit growth. This is very important. Business is very sensitive to the availability of credit. So when there is when credit is less and less credit is available to businesses and enterprises, right, it will definitely impact their growth. And another thing, that the black swan, that we don't know when or what will happen, but definitely with a very high geopolitical tension around, especially in the European region, right? Or maybe in fact even more between US and China, right? We never know what will happen. So this could be a black swan that may happen this year or next year. We never know, and this will definitely hit the market expectation. On the interest rate side, so I mean, I just pulled this out from a report by ING, the insurance arm, the insurance giant. So I think the consensus is they expect the US Fed to hold the interest rate around 5%. Oh, interestingly, tonight, so there'll be a FOMC meeting. So let's see what the market will react tonight after Jerome Powell come out to speak. So the consensus is that US is going to hold the interest rate around 5%, maybe start to pivot towards beginning of next year. But I mean, personally, I think, or I suspect, or I do see that the possibility of perhaps the US to hold a high interest rate at a much longer time frame, it is also quite possible. Especially when you see that unemployment rate is very important. So if the employment in US is still very hot, it's still very sticky, right? I think the US Fed will have no qualms to actually hold the interest rate at the elevated level for even longer period, because the Fed has a very eager focus on bringing the inflation down to their supposedly 2% target. Why 2%? I don't know, but they are very much focused on that. And I think the other central banks around the world, the major economies, are also following in suit, right? So let's see. I hope this won't happen, because if this happens, right, I think it will definitely affect the stock market, prolong our pain, So this is a time where you really are thankful that you have a job. For full-time investors like myself, we actually had to bite the bullet, all right, and really tahan, wait for the cycle. I mean, the headwinds to blow over, and hopefully the recovery period will come sooner than expected. Right. So good news. What are the silver linings? I think there are some good news for us to look forward to. Looks like the supply chain bottleneck is subsiding, is easing, so it takes the pressure off, the pressure points off certain these good prices of goods and services. Commodities and food prices seem to be stabilizing, unless the geopolitical tensions to flare up again, then it will really reverse this stability. Inflation pressures seems to be plateauing. But as I mentioned, whether that will lead to the central banks pivoting their fiscal policies is totally another matter. China reopening, yes, I think the whole world, again, back to the same playbook. The whole world is looking at China for to save the global stock. Investment markets again. Looks like they just reopened not too long ago, so we have not really seen the impact yet But I think gaming, travel related industries are definitely seeing a lot of good news. I think Beijing is also shifting some of their monetary and fiscal policies to stimulate the economy. I think that's a good news. So I think, if I'm not mistaken, China is one of the few economies today that still have a expansionary credit policies, right? Decoupling of global supply chain, as I mentioned, could be good and bad. So for a country, for an economy like Malaysia, where we are friendly to both sides of the world, we should definitely stand to benefit from this. I think you all heard about China plus one. So whichever OBMs or OEMs that have manufacturing facility in China, they have already started a few years ago to shift or to expand to build redundant capacity out of China. So countries like Malaysia, Thailand, Vietnam, Indonesia, Mexico, Poland, Philippines, so on and so forth, we stand to, this emerging economy, we stand to benefit, as more and more FDIs come into our this side of the world. But of course, the key here is whether our government policies are designed in such a way to attract all these foreign investments, right? And good news, because of the the multiples contraction, the downgrading of the earnings per share, which bring down the valuation. So valuations are becoming more and more undemanding compared to a couple of years ago. So this is where we see value emerging in some of the sectors, or even tech. That is why I mentioned earlier on. One of the sectors, one of the strategies moving forward is to focus on value growth companies. So in terms of sector allocation, as you can see here, this is a very high level view of what we are focusing on right now. So still, I would say you can say that we are still pretty much looking at tech, but we are very selective. For example, we are looking more on industrial, companies that especially equipment players, they have solution on how to automate, production. Companies that, like Panda Master, ECA, so on and so forth, they can, or even they call it integrated line, managed solutions providers. We believe that they stand to benefit because more and more producers, manufacturers around the world, whether it's automotive, or solar panel producers, right? They are going for automation. Why? Because number one, because of the pandemic, they realized that actually they cannot rely too much on labor. Number two, they really need to watch the cost, especially the energy costs. I think with the flare out of these geopolitical tensions, we see that the rise of the energy cost was really unexpected. So more and more manufacturers are going for the lights off solution, whereby they want virtually zero labor in their manufacturing lines. They want, which means that you don't have to turn on the lights. It's fully automated. So we believe that solution providers that for automation should benefit. I think IoT is also one of the things that will be more and more popular. So we are also putting this into our investment thesis, right? And there are a couple of companies in KLSE that actually does this. Again, I think renewable energy is pretty straightforward, right? Because financing is cheaper. All right. More and more government policies are actually pro renewable energy. They're able to get cheaper funding, so on and so forth. But more importantly, I think moving forward, companies or the renewable energy sector should be able to command a higher or more attractive valuation or more attractive earnings multiple compared to the rest. So probably even in the realm of 30 times or 40 times is normal because of their growth prospect. So this is definitely a sector that we are eyeing very closely. Now, then you may be asking, hey, David, how come energy, oil and gas, dirty energy is still in your investment purview? Definitely, because I think it is, you can see that actually for the past many years, right? They are virtually getting virtually no new investment into oil and gas, which means no new fields are developed. But the demand for oil is still very much intact, So, just imagine with we don't even need to have rising demand as long as demand is still there, but our supply is getting low. less and less, right, it will definitely cause a imbalance on the pricing. So we believe that in the near term, in the foreseeable future, at least energy will still be very much relevant. In the case of Malaysia, I think you all know that Petronas has been pretty much inactive for many years when it comes to capex. That is why our energy sector has been pretty uncompetitive for the past many years. But things seem to be turning around. I think starting this year, Petronas, according to their product activity outlook AO report, they seem to be reversing the course and putting more capex to revive our energy sector, especially on the gas fuel. So I think a lot of companies that operate around Sabah and Sabah region should benefit, because those are where most of the gas fuels in Malaysia are situated. As I mentioned, value growth is something that we are looking at. So what do we mean by value growth? So of course, that growth means these companies will be on the growth, will be categorized as the high growth sector. So naturally, semicon and tech will be there. But value means what? Value means those companies should have a meaningful cheap valuation, whether it is a price earnings multiple, or price over operating cash flow, or price over free cash flow multiples. There are many ways for us to look at this, but definitely this is part of our this will be in our purview. Good companies, especially the OSAT, I think outsource services and testing solution providers, I think their valuations are getting cheaper now. But if you ask me whether this is the bottom, I still don't know. I think there is some room to go down, unless suddenly the consumer devices demand come back. But I doubt that. So probably we will still need to give them about 6 to 12 months, for the market to discover, what is their price point before things can turn around. And last but not least, we are not afraid to hold a higher cash ratio, cash balance in the portfolios. Even though right now we are about 50% cash balance and 50% equities, we have no qualms to raise this cash in a very short term of time, but hope that. But the problem now is actually market liquidity. Even though we are not very big investors, but we see that there is because I don't know about you, but the KLSE is so dry in terms of liquidity nowadays that sometimes if I sell a certain stocks, right, it will trigger some sort of reactionary, some sort of reaction to the stock price, and people may start just throw, right? So. But what I'm trying to say is we do not have any problem to raise cash even higher, to probably say 60-70% in a short period of time, depending on the situation. So this is what our high level allocation plan is for the rest of 2023, based on what we can see now, based on what we have, based on our recent interaction with the management. So other opportunities perhaps is on the gaming and in tourism related. So I think one of the investments that we have now pretty big is actually in gaming, because of the reopening in China, right, as well as the East Asia in general. So tourism is back. I think among you guys, among the listeners, I'm sure you have, even if not yourself, I'm sure you have a lot of family members and friends who are started traveling during the previous holiday season, right? So we believe that and China just reopened not too long ago, and we believe that there will be a we have not really seen the real impact of the influx of these Chinese tourists to this part of the world. So gaming, tourism is also a sector. And the other one is actually food security. So I think previously we were focusing on the food security from the agriculture's angle, but I think recently we also started to focus on the livestock, the poultry, the protein side of the equation. So one of the companies that we are starting to look at is a company that supply all these animal feed, in this part of in our country generally. So these are some of the sectors that we're looking at. Pretty much excited about it, but we are very mindful of the short-term or near-term challenges. So we are more inclined to keep a higher cash balance for now. Okay, so this is our high-level tactical strategy. It's not time-based, but it's more like event-based, as you can see here. So I purposely do not label the horizontal axis. This is not by quarter 1, quarter 2, quarter 3, quarter 4. Please don't get me wrong. This is all event-based. So I think in the near term, we believe that the monetary policies still remain tight until we see a stabilizing of the interest rate, meaning the Federal Reserve central banks do not hike interest rate even further. Then, of course, if they pivot, right, the yield curves, especially those in the yield curve in US, right, will reverse, and that is where we think market may bottom soon. After that, we don't know how long, but it should not. The bottoming should be near, because normally, I'm not sure if you still remember from a couple of the sessions I had earlier with on live chat. Actually, one of the signs that we look for is the yield curve inversion. The pivot of the yield curve inversion. So right now in US, the yield curve is very negatively inverted. All right, meaning the 10-year is very much yield is measured much higher than the lower than the short-term yield. All right, the interest rate. But once they invert, right, that is where usually the pessimism in the stock market will peak. And then market should be bottoming anytime soon, probably in 3 to 6 months after that. So those will be the time where we really do deploy more and more capital, on value growth stocks. Then ultimately what we're looking at is central bank pivoting from their tightening policies, meaning they start to ease they have to go back to the easing policies by reducing interest rates. All right, by expanding, by going back to the expansionary credit cycles or policies again, right? That will be the time where we think that perhaps market is ready to price to give a more normalized or higher premium for growth companies, right? So hopefully this kind of event base will not drag too long, but we are prepared for this to play out in the next. If it happens in 1 year, great, we'll be very happy. But we are prepared for it to drag, say, 2 years or even 3 years or more. All right. So, but of course, along the way, there'll be ample opportunities. So make sure that you keep on coming back to Live Champ, right? Especially webinars by Spiral Thinker. Okay. By the way, this is just case study. I will come back. In the future events, I'll definitely I'll bring this back again to see whether there is a need for us to update our tactical strategy. All right. So this is just a snapshot of one of our long-term portfolios. Call it Genesis. It's a very nice nickname. Started back in 2020. This part, the third year, is actually what we saw earlier in the slides, right? So this is a real portfolio. So this portfolio in the past 3 years compounded at about a CAGR of 27%, which means it doubled up in 3 years' time already. So pretty good. But of course, you don't expect it to be sunshine every single year. In fact, in 2022, because of our tech exposure, we did pretty badly in the first half, but second half we managed to pull out. So point to point, this portfolio was able to double up in about 3 years' time. It's pretty good. So what I'm trying to say here is, always invest for the long term. Short-term, volatility is part and parcel of our investing journey, especially in this time of in this period, this era, right? Be mindful of near-term headwinds, but always remain invested. That's the key message here. All right, so I think I've covered most of what I want to talk about. So sorry, I thought that I can finish in 1 hour, but it seems that I've overrun again. But before I hand it back over to Shane, to Chun Xian, I just like to borrow something that I learned from Mr. Chu, the co-founder and CEO of VTrox, right? I think back in one of the earnings briefing session for their third quarter financial year 2022 results briefing, he mentioned this statement and it stuck in my mind. He says that during a downturn, margin, because Victrox is known for the margins, right? But to answer one of the questions, he said that margin is not their top priority or the top consideration in a downturn. Their focus is instead on how to capture more market share when the market rebounds. So listen to this and mark this. I mean, I hope that you can remember this, because you can apply this in our investment journey as well. You see, he did not say how to capture more market share if the market rebounds. He said when the market rebounds. So the same thing here in our investment, right? Yes, we are likely going to slide into recession soon, all right? But I mean, after, no matter whether it's going to be a long, a short or long recession period, right? The market is going to rebound because, you know, humans, as I mentioned, we are a surviving species. We are a thriving species. So definitely there'll become a point when, you know, things can be fixed, you know, no matter how screwed up the economy is. I'm sure that, you know, the experts around the world, I mean, the economists will be, the central banks will be able to come up with a solution, right? And when that happens, as I alluded in our high-level long-term tactical strategy, the focus will be how to capture more market share, meaning in terms of portfolio lingo, how to invest in more quality business that will grow over the long term. So with that, thank you for your time. I hope that with this sharing, I managed to at least, you know, dispel some of the fears on on the upcoming recession. You know, all right, Chun Sian, back to you.
Thank you so much, David, for sharing with us your strategies on how you all will navigate through the recession. So if any questions to ask our speaker today, please write them in the Q&A box. All right, so the first question is by Lee. With the announcement of a higher OPR today, does it hint about a possible recession?
Okay, I think you're talking about Malaysia, right? I think Malaysian economy is still very much resilient. Even when the BNM hiked by 25 basis points, so now our indicative interest rate is about 3%, right? 2.75 to 3.25, 3%. So it's still pretty much on an acceptable range, in my opinion, unless, of course, you are talking about highly leveraged individuals, you know, in terms of whether it's in properties or, you know, have very highly leveraged in terms of debt, you know. So, but I don't think it will have such a big impact. But what I fear the most, just to share with you, Lee, it's not this. It's actually because I think the Bank Negara, so far, whatever they are doing, the policies is pretty much practical, and you know it reflects that they are doing the right thing, and they cannot, as if central banks, let's say in US, will keep on rising the interest rate, they cannot avoid doing the same thing. Otherwise, you know, they will lose out, right? Now, what I'm more worried about, or what we are more worried about, is actually the subsidy policies on the government. And we all know that the government the income has been affected because you know, last time there were no GST. Now, you know, Petronas, you know, there was not much development, so the dividend income is affected as well. We are more afraid of, you know, some of the policies like, you know, lifting of the subsidy on the gas, on the petrol. I think that will have a huge impact on Malaysian economy, right? But other than that, when it comes to interest rate, I think, yes, there may be a short-term knee-jerk reaction, but I think overall 3% is still very much healthy. Not unless you talk about 100 basis point or 50 basis point in one shot, that could have a even more bigger impact. But to answer your question, I don't think there will be a huge impact which will lead to recession when it comes to Malaysia economy.
Certainly. Now, I think recently I also heard about one more bank in US who also went bust. And it has been probably the fourth bank in US that went bust. The first was Silvergate, then the
Silicon Valley.
Silicon Valley Bank,
First Republic,
Signature Bank, and I think
First
Republic Bank. Do you foresee that, you know, this is a short-term thing, or it will end up in a bubble?
Wow, Say, I'm not economist, but yeah, I think I read somewhere that there are more than 10,000 regional banks in US, right?
Mm,
And what is happening is actually because okay, what constitute big banks and smaller banks in US? Actually, if the bank is capitalized less than 250 billion US dollar, right? They're not considered, they are not in the big leagues, right? So a lot of the banking regulations do not apply to these smaller banks. And in the past many years, these smaller banks has been lobbying for even more and more relaxed regulations on their operations. So I do not, okay, as far as I know lah, to be answer you truthfully, I don't think there will be a systemic effect because the big banks are always ready to step in. They'll be instructed, and I'm sure that the central bank, the Federal Reserve, is ready to step in with all their financial tools to stem any further deterioration of the financial system, because financial system in US is absolutely important until they become a point where I would not say it's impossible. But if it so happens that it becomes, the balance, the balance is broken, meaning it becomes too big to contain, then probably that will be the time where everything will go, the pendulum will occur, and I think that will have a huge impact not just to US economy but to global economy. So probably that is one of the black swan events that we will be we will be mindful of. Junxian, are you still there?
yep. I just realized that I was on mute.
Sorry.
Thank you so much, David. So are banks under your portfolio? That's the question, right?
No, Maslan, right? Sorry.
Yeah.
Banks are very tough for us to digest when it comes to the balance sheet. So far, I have been investing for more than 10 years. I still do not know how to study the financial statements and balance sheet of banks. And to be honest with you, a few years ago, many years ago, I used to know a very good friend who is a VP in a local bank. I asked him, hey, bro, do you invest in banking stocks? You're an expert, right? He said, no, he won't invest in banking stock. So there you go. I would rather invest in companies that are simpler, less parameters for me to study. And that's it. So unfortunately, banks is not my cup of tea.
Yeah. I think some investors like banks for their stability, and some investors don't like bank for their leverage position because they loan out a lot of money, right? So this is kind of irony.
Since you brought this out, right, it's actually very ironic,
Yeah, it's very ironic.
If you ask youngsters around, especially youngsters these days, right, whether they trust banks, you may be surprised with the answer you get. Especially with the collapse of SVB, with Silvergate, right? I think the trust level on banks these days are really on the low now. So there you go.
Yep. But I think Malaysian banks in general are still pretty
Malaysian
conservative.
Banks are still pretty much
conservative.
But there could be a silver lining here. What we are watching for is a possible consolidation of the financial sector in Malaysia. So hint.
Okay, see whether there are any M&A activities or not.
Yes.
All right. Edmund would like to ask, do you invest in diversified conglomerate companies?
Yes, conglomerates are also one group of companies. I mean a particular group of companies that we do not invest in. For example, YTL. For example, these are Simon Darby. Because their business is so diverse and so complicated, right? That there is no one single breadwinner. And in fact, most of the time, what you notice is there'll be one or two segments that really make money. But then it will be, there'll be some other departments or some other segments of business that drain those profitability. So I do not invest in conglomerates. But case in point, let's say companies like Sunway, and we all know that Sunway is a pretty well-managed company, and they have a very healthy, very quality asset base. Their hospitality, their education, their healthcare, right? So probably the exception would be, let's say, companies like Sunway, right? But generally, I we usually stay away from conglomerates.
All right. Thanks, David, for your perspective. The follow-up question by Edmund are EV cars considered creative destruction for
Yes,
internal
definitely.
combustion engine?
Yes. So and you have seen that traditional or these automatic car makers, right? They are actually disrupting their own business because companies like Ford, even high-end brands like BMW, Mercedes, they are actually making inroads into the EV space. So there's a saying, either you disrupt yourself or the market will disrupt you. So definitely the automotive sector is definitely going through a creative destruction phase. And the answer is EV, or even some companies are actually investing a lot in batteries for now, because battery forms a huge chunk of the cost. But of course, electrification of vehicles is not the only solution. I think some producers like Toyota, they are going for the other option, which is hydrogen. Whether they'll be successful or not, personally, in my personal point of view, I'm not sure. In fact, I'm not so positive on that. But I believe I'm a true believer of EV for the future. Yeah, so that is good. Thank you for bringing that up. That is definitely a good example of creative destruction.
Thanks, David, for answering the question. Lim would like to ask, is semiconductor at the bottom of the down cycle already? If not, when will the bottom be?
Okay lah. Lim, since you brought this question and it actually touches on my COC, right? So I don't want to answer just on the angle of Malaysia. I'm just very huge, very big, very general. So semiconductor, I think the front end, which is the wafer manufacturing, the wafer manufacturing side, is going to do very well. It's still going to do well. You know why? Because of all this national security, US is pumping a lot of money, and then the biggest wafer producer in the world, which is TSMC, they are investing all around the world more than $100 billion, right? Much more than what US has committed. So that will definitely have a positive inroad for all these equipment makers, all right? And in fact, there are some companies in Malaysia that will stand to benefit because of this reallocation, or what we call reshoring of these front-end semiconductor players. But further down the value chain, which is on the back end, right, the packaging, the testing, right? So I think I do not think that the bottom is near. I think that they still have some time for the market to digest the inventory, which is still very much high at this level, right now, just like the glove stocks. All right. So probably right now I'll be focusing more on the front end and not the back end. Yeah.
All right. Thanks, David, for your perspective. Okay, let's do one last question from Wing On. From the recent data from US, consumer spending is still positive, unemployment rate is still very low, and the ISM manufacturing index is still positive. Personal income growth is also positive. So what do you think of the severity of the recession when it hits?
Okay. Okay, good. You actually just mentioned a lot of these short forms, ISM, PMI, so on and so forth. But I just want to point out that a lot of these indicators are lagging indicators. So they're reported either last month or last quarter, right? So they may not be a true indicator of how the economy is doing now. I think, as I mentioned just now, as I alluded earlier, one of the sectors that you should be focusing on, I mean, if you want to really study deep into this, is real estate. So I think real estate will give us a big clue. But to answer your question about how severe it will be, my guess is as good as yours. But I stand to I'm in the camp that the recession may not be as bad as what everybody feared. In other words, I do not think we will go through. I think that the chances of us going through a 1930s kind of depression, for what I know now, or what we gather now, is very unlikely to happen. But never say never. Yeah.
All right. Thanks so much, David. Okay, looks like we have run out of time. Of course, I know there are more Q&A here in the Q&A box, but we can't do any more of this, take any more of your questions. So apologies for that. So with that, we would like to conclude our webinar tonight. So ladies and gentlemen, you just heard from the founder of Spiral Thinker Group, which is Mr. David Paul. Thank you so much, David.
Thank you. Thank you,